Hello, I'm Graeme Bibby, Chief Investment Officer. We're talking today about Partners Private and an introduction to alternative investments. So what is Partners Private? Well, it's an offering of bespoke investment opportunities that are available to individuals that are normally available to investment banks, stockbrokers, family offices, and institutions. We believe that clients should have access to these and have them available where they're previously only available to those other organisations and families. So how are we doing this? Our offer is to offer high-performing portfolios through different asset classes and do that across a range of asset classes from property, equity, debt, and areas like agriculture and infrastructure. We have a deep network that we access those through and look at hundreds of opportunities a year and filter them down to 8 to 10 offerings per year overall. These are normally available at least for $1 million per transaction. Normally it's 5 to 10 million, and we make them available for $100,000 minimum. So let's have a deep dive into some of the aspects of what alternatives are, and we'll talk more about that in future presentations. So why Partners Private and the approach to have these type of investments in your portfolio? Well, then they've been used in endowment funds and like the Harvard Endowment Fund and the Future Fund for many years. And in a year like 2022, where equities were down 20, 30%, bonds were down 13%, then your portfolio can be isolated from some of that performance by having these investments in there. In fact, some of our clients who have about 50% in alternative investments in private markets and 50% in listed have achieved positive returns in 2022. So even better than the endowment sometimes. So we believe firmly that individual investors deserve better, that you should have access to institutional quality investments that wholesale investors normally see across a range of asset classes with partners like the ones that we've got on the slide, where there's strong governance of selection, an investment committee process, deep due diligence, and we're rejecting many of these investments before they even get to our final processes. We have strong target asset class criteria where it's got to be at least at 8% minimum return. Usually that's for private debt investments. But in property investments, it's usually in the double digits, and we see strong returns from many property asset classes and opportunities, through to private equity and venture capital, and also agriculture and infrastructure. So let's talk more about the why of Partners Private. We think that Australian portfolios have been too dominated by listed equities. We believe that clients should access these investments to isolate some of the volatility of their portfolios, but also get better returns. And these are the returns that are being achieved by sovereign wealth funds, industry funds, superannuation, and Australian family offices. So as we said before, we're doing this through wholesale access vehicles and opportunities in all of those asset classes, and leveraging on our networks across family offices, insurance, superannuation, institutional consultants, and many more. So why private investment markets? Well, they return better generally than public markets, so listed equities. That's the main reason. But they also are less volatile. So you can have better returns overall, but there's also ways to increase your returns by selecting persistently better performing managers, by selecting middle market managers and strategies that access mid-sized opportunities that perform better than large and small, by selecting managers who also have operational and development improvement to the assets. You can't really do that with a listed equity. And adding allocation when things are going through cycles. So like now, many assets are cheaper. So we'll dive into some of these in more detail. So we've seen the growth of alternatives over the years, and by 2025, we see that it could be as much as 24% of the overall investment universe will be in these alternatives, both public markets and other forms of alternatives. We also see performance persistence. That means that if a fund performs at the very high level for alternatives, they tend to perform at that high level. Also, lower performing funds tend to perform at a low level, and eventually they don't attract any capital at all. On the chart on the left, you'll see that in asset classes that are in mostly public markets, the dispersion of returns isn't very wide. So a listed equity fund might be up or down, but many cluster towards that median return. In private markets, however, particularly private equity, venture capital, and infrastructure, the dispersion is a lot higher. And those managers who stay at the very highest level of their performance tend to stay there. On the chart to the right, the most recent performance you can see for different forms of private equity, those managers perform many multiples above the worst performers, so tens of percent. There's a trade-off between liquidity for returns. So that's one of the features of private markets alternatives that you see. You'll have to lock up for a period of time. Sometimes that can be a shorter period, like 1 to 3 years. Sometimes it can be 5 to 7 years or even up to 10 years. But for that, you're getting a return of multiples on your investment and internal rates of return for private equity and venture capital in the 20% area plus. Some funds are open-ended though, so they do allow some liquidity and some ability to invest quarter by quarter into and redeem out of funds, usually for some initial lockup of anywhere between 18 months to 3 years and beyond sometimes. But they'll have a limit to the amount of liquidity that can be withdrawn. A key question is to look at what redemption facility there is there and how is it matched to the underlying assets. And in a crisis, just be aware that the liquidity may not be there. So that's why you have other liquid assets as well. So tie up what you're prepared to tie up and you'll get better returns for that component. So what does the spectrum of alternatives look like in private markets? You can have income-oriented alternatives, capital gain-only alternatives, and things that are a blend. So income, there's a few different debt strategies from real estate loans, corporate loans, structured debt, and even esoteric strategies such as insurance-linked catastrophe bonds, for example. Capital gain-oriented strategies are private equity and venture capital, and there's some others in that, and that's where you're getting a capital gain, but you're not receiving an income along the way. You'll get a capital distribution, but you won't get an income distribution. And then there are blends, the traditional ones that we're used to, property, where you have some income and you've got some capital gain. Infrastructure is another blend, so is agriculture, and often strategies that are land and business type strategies like owning a pub, land and building, and the business as well. There's a spectrum of returns, so going from very conservative core investments, think of a property trust that's fully leased, to core plus, maybe it's got some rental vacancies or some minor refurbishment that's needed, to value add, and the returns go up as you go up the spectrum here as well. Value add where it needs some major re-tenanting, some major refurbishment, or a repositioning, or some bolt-on of some extra facilities to that building. Opportunistic encompasses all of that, but it can also include rezoning strategies, greenfield development where you're just building something from scratch, and where things are priced very cheaply as well, or there's some opportunity where the fund manager can be part of a solution. We think it's very important to be tilted to the right areas of the spectrum at the right points of the cycle. An example of that cycle is in the property market. People are quite familiar with property ups and downs, and we've seen that over the last couple of decades. So with office, for example, that's gone through phases up and down, but we've seen, interestingly, a reversal of industrial being the highest yielding asset class and seen as being the least preferred, to being the most preferred, as we've got a lot of logistics and third-party logistics suppliers for online sellers coming in, and a lot of population growth that needs more distribution of logistics. To retail, which has suffered through the pandemic, is now seen as a more risky sector. It's really important to understand that in times of stress, there can actually be opportunities. So in the example of private equity, during periods of stress during the dot-com crash and during the global financial crisis, the difference between, in the light bar, the returns of private equity managers and what you would otherwise be getting from public markets or listed equities, that difference really expands out and there's better returns than even the normal better returns that you would get in the times of stress. So we're actually in one of those periods now where we've had the COVID period and the downturn that we're about to go through now, and prices are cheaper and there's been pricing adjustment. So we think that there's periods when you want to be positioned to these sort of assets. So inflation can also be something to look at. If you're worried about long-term capital preservation of your purchasing power, consider the role of different forms of alternatives and their linkages to inflation. Some pretty clear ones are commercial real estate that have linkages to inflation in their rental agreements. So that's pretty direct. Infrastructure as well. So think of toll roads that you have to keep on paying with inflation as they go up. And commodities are part of that story as well. So there's a range of different alternatives that can give you some hedging to inflation. And the middle market effect, we think this is really important. So we want to access things where there's just better returns than the very smallest and the very largest investment opportunities. And there's reasons for those structural changes to be taking place. If you think about in the economy, middle market businesses, so medium-sized businesses, still have a lot of potential for growth, and many of those perform very well in terms of growth compared to the largest economies, which have really got nowhere else to grow, and smaller companies that maybe suffer from too much competition and there's a lot more risk for them. There's a similar thing in middle markets investing as well, where you can access investments where there's just better returns because there's less competition. The very biggest investors, like large super funds, will only be looking at things 200 million plus. Whereas if you're looking at investments under that, then they're going to be more attractive. So how do we look at those things through the investment committee? We're looking at all these things and assessing each asset class in turn. So each of the investment committee members brings different perspectives from their industry, and together we're able to provide different views on the investments. Nick Stretch has a legal background. He's chair of the investment committee. I have a background in fixed interest, alternatives, and institutional investment and family office. Andrew Donaldson in property, Matthew Leong in private markets and public markets equities, and has some family office experience. So we've all seen a lot of investments, and we're able to review all these investments according to the criteria and looking for the things that we talked about. We have a process which I won't go into detail here. We've got another presentation that you should listen to that goes through our process, but in summary, we screen hundreds of investments. Some get to the investment committee and they then get the okay for further detailed due diligence, where we're only selecting 8 to 10 a year, and they undergo, in addition to the investment due diligence, detailed financial, legal, and operational due diligence, and a sign-off by the investment committee. So what we're doing with that process, and this leads to our selection, is that we have a lot of sourcing opportunities, a lot of networks that we can tap into, and an example of some of them are through third-party marketers, conferences, through different specialist areas of asset classes, and from institutional to retail oriented, from institutional opportunities that we find through our networks of insurers and family offices, and many other sources as well. So we research outbound, we look for those opportunities and screen them, and we also get inbound opportunities as well, hundreds a year. When we're looking at an individual investment, we look at what makes them smart. So look at the team track record, how are they performing, and what's the product structure? What makes them different? What's their edge or niche that they operate in? And do they have a differentiated process that will stand up to scrutiny and competition over the long term? And what makes you careful? So the risk management and mitigation of issues with the industry or the investment. And where things haven't been approved, it's often through just not enough track record, problems with the manager's management of risk, or that they're just not concerned about preservation of capital, or there could be some other issue like reputation or the valuation policy. So overall, our competitive advantage is that we access these investments and we access them through different feeder fund providers as well. An example is Silk Group, Our scale leads to opportunities that we can see earlier, so we're able to raise capital of anywhere between 10 to 50 million, so that makes us a very attractive partner for those middle market investment firms and opportunities. And we're able to reduce the minimum investment down to 100,000 per deal, which means that things that would normally require $1 to $5 to $10 million, you can access for $100,000. And overall, we've had 21 investments to date and some more coming this year, 177 million in exposure through a variety of property debt, corporate debt, private equity and others. Our focus is really on capital preservation and making sure that the returns are fair and competitive for each asset class. And by seeing hundreds of deals, we can pretty quickly work out which ones will get through that filter. Thank you for listening, and for more information, please refer to the Partners Private website, your advisor or accounting partner, and we look forward to talking to you more. Thank you.